So I'd now like to hand over for our first speaker of the day to Malcolm Myers. And Malcolm has been a long-time presenter at the conference, and what I like about the topic is he's going to talk about back to the future of classifieds and marketplaces, and it's almost like a follow-on conversation from where we were 3 years ago. So Malcolm, over to you. You got that? No.
So good morning, everybody. It's great to be back after 3 years. So I'm Malcolm Myers. I have been working in the field of classifieds and marketplaces for over 15 years. I started off as head of M&A at Naspers, advised Scout Group for several years on M&A. And I run today an advisory business called European Internet Ventures. We do M&A and capital raising for marketplaces. The buy-side M&A is usually with private equity. The sell side is usually helping founders monetize and sell out their businesses. And the capital raising is usually Series B and later. And although the company is called European Internet Ventures, we do work everywhere in the world. Here are just a few examples of customers or clients and transactions we've had. So I'm going to start today's presentation looking a little bit at what's been happening over the past 3 years since we were last together in Bangkok. Which of the transactional models or other types of portal models are likely to be successful? And if you sitting in this room running a portal, perhaps in this region, what options do you have today? And then finally, I will revisit some of the perhaps rash predictions I made when I was last on this stage. So what's been happening? Well, the first thing to think about is that if you had been investing in classifieds when we were last together, you wouldn't have made very much money. In fact, you would have probably lost money. And what's the reason for that? This chart shows market cap. What has happened is that the multiples at which investors are valuing the revenues and EBITDA that are being generated by these businesses have compressed. So, REA used to be around 30 times, it's now around 22 times EBITDA. And then if we look at the transactional models, I'm thinking about iBuyers like Opendoor or OfferPad, looking at what I call the tech-enabled brokerages, so those big brokerage models like Compass or Redfin, of course, valuations have been totally crushed. And then if we look at Zillow, who obviously went from classifieds to iBuyer, you can see here that when they announced that they were going to be doubling down on iBuyer, their stock market valuation went up to roughly 35 billion, and then soon investors realized, although the revenues go up, the losses also increase just as fast. And of course, since they have withdrawn from this space, withdrawing Zillow offers, their price is now basically back to where it was back in 2019. So was the market wrong to get excited about these pure transactional platforms? Well, let's face it, the core classifieds process, if you look at, the core classified process, in my view, is still broken. If you think about that beautiful click to buy on Amazon, where everything happens on the same platform digitally, we're still a ton, we're miles away from that today, right? So what do we do in portals? Typically on portals, we generate a lot of traffic, we get a lot of eyeballs clicking on property listings, and then what do? We send those users offline to deal with often very traditional agents. Now, as you saw, I've also worked a lot in other classifieds verticals, including automotive, and I think it's interesting, I know this is a property conference, but it's very interesting to compare what's been happening in other verticals and see to what extent the same changes might be about to come and affect us here in property. So if we look at classifieds, if we look at the non-classifieds new entrants in the vehicle space, what are the kinds of models they've been adopting? So we've got the instant cash offer model, for example, AUTO1 or Frontier Car Group, where the platform is buying the car. We then have a model where the platform facilitates that specific dealers will make you an offer for the car which you want to sell, the company like Motorway in the UK. And then finally, we have the sort of what I call the iDealers. So these are the dealers who are buying your car off you and then selling it on to another consumer. If you then look at what are the classifieds guys done in response to these developments, then there are a number of very similar models. So the instant cash model has been adopted by virtually every car player in Europe, also OLX Autos, who are also active in emerging markets. The direct offers from dealers market, again, very, very popular in Europe, and also car sales in Australia has been doing something similar, Auto Trader in the US. And then commission sharing. Commission sharing is a model which has also been adopted by some of the automotive classifieds players. And then this rather convoluted phrase, the e-commerce overlay to digitally enable stock. Well, what's that about? Here, this example, for example, AutoScout Smile in Germany, is there are about 30,000 click-to-buy cars on AutoScout in Germany, but the cars are actually belonging to the dealers. So AutoScout is creating an e-commerce interface so you can effectively click to buy. And if you do click to buy, then there's some offline stuff going on where AutoScout will actually then buy the car off the dealer and get it ready and ship it out to the buyer. Very interesting model. Similar model also adopted by car sales in Australia. And then the final version, which is one I find particularly interesting, is what I call the in-house dealer. So here, you have a classifieds business that also has its own dealership. So OLX Autos is a great example. You have OLX as the classifieds business that some of you will know, but they also have their own dealer that's buying and selling cars called OLX Autos. And then particularly interesting in this part of the world, we have iCar Asia, that of course owns some, including the leading car classifieds business here in Thailand, and they have been acquired by the #1 vehicle transactions business in the region called Carson. So what can we learn from this? I think there are probably 4 things to take away. First of all, that many classifieds players have used M&A to accelerate business transition to the transaction. Secondly, that models which offer a role for traditional dealers, like that AutoScout Smile model, can be very successful and also help to reduce the capital needs to get into the transaction. I would also argue, thirdly, that classifieds brands can actually use and co-brand with that very well-known classifieds name, think of OLX Autos, also for an iDealer or a dealership, a transactional model. And finally, it's possible for a classifieds platform to also be itself a dealer or broker without alienating those other subscribing customers. So what does it look like in the world of real estate? So transactional challenger models, we have the C2B models, instant cash offer like Opendoor or OfferPad. We have the direct cash offer. We'll know there's no model where brokers are offering you cash for your house on their own books. B2C, of course, we have what, again, I call the tech-enabled brokerages, a lot of those. So those are, again, the non-classifieds players who've been moving into the transaction. And then what have the classifieds guys been up to? So first of all, the instant cash offer model. We used to have Zillow Offers. Some of you will have followed that. In Turkey, we have Emlakjet. So again, the classifieds business is making an offer to buy your home. But Turkey is an exception. Turkey has 100% inflation. So of course, sort of the day after you've bought that house, the price has already gone up. Direct offers from selected dealers, well, no. There's no classifieds player that's getting real estate brokers to actually offer you money for your house either. But we do already have the vendor lead business. So the classifieds portal is getting effectively getting an agent to show up and say, I'd like to sell your home for you on a commission share basis. On the B2C side, commission sharing, really interesting. So there are 2 or 3 different variants here. Vendor leads, which are then resulting in a commission share. Companies like Meilleur Agent in France, Immoverkauf in Germany. Then, of course, we have in America, we have Zillow, who through their Flex offer are effectively saying to their brokers, don't pay to list, but we'll share the commission when you're successful. And then in this region, we have, I would say, 2 commission models. We have the direct sales force model. So the portal has its own direct sales force who are typically selling off-plan or new developments, and they're getting a commission paid for by the developer. And then, of course, we have co-brokerage models, where the portal is, again, is allowing agents to list and then getting a commission share. And perhaps Property Scout could be an example of that. E-commerce overlay, well, we don't have that yet in the property space, although Rightmove in the UK is beginning to build a kind of rentals transaction, a layer which will then facilitate the rental of properties which are being managed by agents. And then finally, again, my favorite one, in-house tech-enabled brokerage. We have on this side here, we have, and I'm going to get it wrong, but it's KE.com, who are also presenting later on. So that here you have the largest property portal in China that also belongs to the same group as the largest brokerage group in China. And then Georg will tell you this after my presentation. GUI, IQI, again, is a bringing together of a portal and a very large brokerage. So we've seen an overview of all the different models. Which ones do we think will be most successful? So if we look back again at the sort of traditional real estate agent, and again, these are pictures from Europe, but I think the same would apply to some of the countries represented here. Portals are very reliant on subscription revenues from what I call long-tail real estate agents. So typically agents doing 20 sales a year or less. But much of what those agents are doing today can be done much better with better, faster, and cheaper with software and data. And if we think of the sort of different phases of a transaction, you've got preparation, buyer management, negotiation, and closing. It's only really the areas which are largely clear here, like conducting viewings, which are best done by human beings. And I would add perhaps negotiating with buyers and ongoing advice and support. So there are only a few touch points that really require human effort, and the rest, in my view, can be done a lot better with data and technology. And what does this mean? This means that over time, the real estate agency landscape will likely see a consolidation into a smaller number of much larger tech-enabled brokerages. And you can see, for example, on the left here, traditional agents who will either have to adapt or fade away. In the middle, we have agents who are investing very heavily in technology, so these are obviously the much bigger groups. And then, of course, we have the born tech-enabled brokerages on my right. Second thing to think about is that subscription models, in my view, do not capture the full marketplace opportunity. Let's think about that for a second. You've got Rightmove, probably one of the most successful portals in the world. How do they make most of their money? By selling premium slots, so that you pay more to bring certain properties to the top of search results. Now, so Rightmove makes the most money if it can sell you those top slots, for several weeks or months for a given property. Whereas in the future, we would actually expect property portals to get better and faster at matching you. But if you're getting better and faster at matching, then of course a time-based model for paying for premium doesn't work. Imagine a dating site. Well, and they of course are charging monthly fees. Imagine a dating site that brought you the love of your life on day one. You'd never make any money on that basis. They want you to meet lots of different people and take you through a very painful process and charge you 6 months subscription until you find the right partner. And it's basically the same idea. Let's think there about Zillow. So Zillow, of course, they stopped the iBuyer business, but they've transitioned in classifieds into a more performance-based and increasingly commission-based model. If you look at how they present their results, although, of course, they have listings that cover the whole of the US, what they focus on is revenue per transaction. $4,000, by the way, is a very good number, and they're getting that by commission sharing on buy side, on sell side, and on mortgages, and on closing services. And so they managed to make $1.5 billion from having this transactional involvement in 360,000 transactions. Contrast that with Rightmove in the UK, maybe it would be similar to looking at Property Guru in Singapore, which still talks about revenue per advertiser, and they're doing it incredibly well, but it's still an advertiser focus. It's focusing on what's the maximum number of advertisers can I have, and what's the most I can get per advertiser. But when you work out what they're getting per property that lists on their platform, we're talking about a few $100 compared to the thousands of dollars of a Zillow. Sell-side leads is something which has really come up since we were last talking together. So inventory shortages, in particular in the past few years, have accelerated focus on generating vendor leads. Now, virtually every single portal in Europe, in addition to bringing buyer leads, are now bringing seller leads. And why is that interesting? It's interesting because seller leads are increasingly being given on a commission share basis. So for the first time, that taboo of a portal, and certainly it's been in Europe and the US, a taboo of the portal getting a share of commission stream, that's over. And that opens up many, many opportunities for portals. Let's just spend 1 or 2 minutes on iBuyers. iBuyers, of course, what's interesting about iBuyers is, one, that they're still around, and two, that why are they still around? They're around not because they're buying a lot of properties. They're around because they're getting better and better at selling financial services. So BBYS stands for Buy Before You Sell. A company like Opendoor will say, hey, you want to buy a new house, go and buy that new house. We'll give you a bridging loan. And then when you've found it and you've left your old house, we'll take over and sell your old house. Wonderful idea, but perhaps not so easily done with high interest rates. But over the medium term, I think that's a very interesting service. So you could also, so I think that's very interesting. We're also seeing in Europe, iBuyers partnering with agents. So not only you have the iBuyer, but it's also that who will occasionally buy property. Of course, they also get lots of seller leads because 80 or 95% of people who want to sell to an iBuyer don't get an offer. But of course, the iBuyer gets a ton of leads. And so guess what they're doing with those leads, those vendor leads? They're selling them then to agents on a commission share. And that's happening more and more. And then additionally, you're having agents who are bringing their own properties also, for example, onto a Casavo or a Codit, so that those what were originally iBuyers are becoming what I'd call general real estate transaction platforms. And in fact, in many markets around the world, we're now seeing these online marketplaces who are fully transactional. Loft, again in Brazil, used to be just an iBuyer. Now agents can bring properties to Loft. Loft isn't buying those properties, but they are marketing them and sharing in the revenues. Similar stories, also Husby in the Middle East and Tapu in Turkey. So that's a bit of an overview of what's been going on and the different models. Now, what are the options you have as a portal? So the current market is fascinating in that it offers businesses the most extreme set of opportunities and threats we have seen so far. You know, the threats include falling transaction volumes, those long-tail agents disappearing, which means if you're on a subscription model, you have fewer subscriptions to sell. Those tech-enabled brokerages taking up more and more of the market and being tougher and tougher clients if they're on portals at all. On the opportunity side, you have the opportunity to build or buy your own brokerage, or to offer these fintech products, buy before you sell, or to provide vendor leads on a commission-sharing basis, for example. But let's face it, in terms of unit economics, if you are a dominant portal, and again, think of Property Guru in Singapore, for example, RIA in Australia, then a dominant classifieds portal is really hard to beat. Look at the revenues. So, you know, this is a unit economics approach. So Rightmove in the UK, about $300 for every property listed, if you just divide the total revenues of Rightmove by the number of properties sold. Compass is getting 100 times more money per property that it lists. That's because it's a brokerage model. And Opendoor 10 times more than that, because they're actually buying homes for $250,000. But of course, when you start looking at gross margin, Rightmove's keeping 94% of that $300, whereas Compass is keeping just 19%, the rest is being paid to a brokerage, and Opendoor even less, 8%. And then, of course, sales and marketing. Look at the sales and marketing costs. Rightmove, hardly any. Why? It's got a huge brand, lots of direct traffic. Compass is spending $2,000 in marketing to sell one home. And Opendoor, $14,000. Again, they don't have the scale yet to share that out, and maybe in a few years' time they might. So the bottom line clearly is that Rightmove is making 76% EBITDA margin, the tech-enabled brokerages are break-even at best, and Opendoor is losing money. But although we love that classifieds model, not every market will produce a RIA, a Rightmove, or a Zillow. And if you look at this chart here, we've got, on the bottom we have small, medium, and large markets by population, and going top to down, we've got markets at the top where one vertical dominates, at the bottom where a horizontal dominates, and in the middle we have what I call the sort of the competitive middle, where no clear player dominates. So yes, so a company like Aria, again, Property Guru, Rightmove, Zillow, these are extremes in being dominating in their markets. There are a few dominant horizontals, but most of the people sitting in this room are what I would call in the competitive middle. And there, you're not going to, because it's a competitive middle, you're not going to be able to charge the same fees on an advertising model. So do you become a brokerage? Well, if you look at standalone brokerages, tech-enabled brokerages, the economics are not very compelling. You know, some make, again, a good amount of revenue. Here we see differences between $1,800 in the UK, $28,000 in the US with Compass, obviously much bigger, more expensive houses, and US commissions are higher. But again, similar to what I was showing earlier, the profitability of these models is not great. Why? Because they're giving anything up to 90% of, EXP is giving over 90% of its revenues back to the agents. So how can you produce a high EBITDA margin if you're giving away 80 or 90% to your brokers? So these models are, and look, if nobody made money last in 2021, then they're not going to be making money anytime soon. So these models standalone are not generating very much profit. But what is interesting is if you combine the Rightmove model, those portals, with a tech-enabled brokerage, I think you transform the business. How is it different? Well, if you think of a standalone tech-enabled brokerage, it has an AVM, but it's patchy because it doesn't have enough data. It doesn't have countrywide data. It doesn't have enough volume of data points to have a really rich and powerful TEB. Combine it with a portal, and what have you got? Far more data to enrich that model. Well, let's look at the buyer management side. In terms of investments in branding, the portal already has a huge brand, so you don't need to, so you're going to save some of those $1,000 to $2,000 per transaction. Think about vendor leads. So every buyer on a portal, most of them are also sellers. Those seller leads can then be converted into vendor mandates, either for the in-house brokerage, or if not appropriate for the in-house brokerage, then of course to your paying, subscribing brokers. So I think, again, the overall scale which you have when you combine these two businesses probably allows you to invest more heavily into the platform and create a better technology and a better experience for your buying and selling customers. So let's revisit what some of those predictions were and see to what extent they've come true. So when I was last here, we talked about three different models. We talked about Classifieds 3.0, a Shopify model, and we talked about an own-label, tech-enabled brokerage. What's been adopted so far? Well, virtual tours is standard. I think we needed that in the pandemic. That was an easy one. Conveyancing services was another aspect which we talked about. Zillow, for example, offers this service and is making good money out of it. Kind of adopted. What's been kind of adopted? Well, what's interesting is how tech-enabled brokerages are beginning to combine with classifieds. We obviously have this wonderful example in the region just a few weeks ago, thanks to Kayzo, Dot Property acquiring Fazwa. So there you have a classic classifieds business that is acquiring a brokerage capability. And in Europe, we're also getting a step or two close, so we have sell-side mandates, as I said, and commission sharing on sell-side mandate, which is definitely one step towards portals being much more active in the commission. And then what hasn't been adopted yet, well, buy before you sell fintech plays aren't happening yet, but I think they're going to come when the interest rates go back down again. And the Shopify model, where again the portal is acting as that digital experience for all the brokers behind it, that isn't happening quite yet, but as I mentioned with Rightmove, it's starting to happen on the rental side. So just to wrap up, I think without developing an on-portal transaction capability, classifieds portals will either fail to monetize, as is often the case in emerging markets, right, where you can't get enough revenue per property from a pure marketing business model, or in maturer ones, will increasingly lose out as those long-tail agents start to disappear and better-funded tech-enabled brokerages start to generate their own leads and their own business and need the portal less. But by proactively embracing the transactional opportunity, classified portals can build a stronger business, delivering higher satisfaction from home buyers and sellers alike, due to the inherent benefits between integrating a classifieds business with an on-platform transactional capability. And I think if we look at Quinto Andar or Loft or Tapo, you can see how in less structured markets, these collaborative models with agents and portals on a commission sharing can be agent inclusive and very successful. And again, Dot Property and Fazwas is a great example of that. And I think then in mature markets, you have less scope, but certainly commission sharing is one step forward, and fintech, and together, I think that will provide a win-win formula for classified businesses to raise revenue per transaction in a profitable way. That's it from me. Thank you very much.
Malcolm, thanks for that. First of all, can we bring up the questions? Okay, which would be excellent if you could. Are we looking at the right thing? You might want to bring up the next one. Because I know there's a question, I got it here, because I wrote it. Okay, so I'm going to ask the question while they get this sorted out. Okay, you're looking before you're comparing Zillow with Rightmove.
Yes.
Right? And to what extent, though, is it the market structure that drives that opportunity? So in the US, 6%, MLS, commission sharing, it's all, everyone feels comfortable. Rightmove, United Kingdom, agents get 1%. So is Rightmove actually punching above its weight in capturing a percentage of the commission? I
think it's a great question. I mean, okay, the UK has quite high property prices, so I think it's 1% of a good number. Simon?
Yep.
But I think clearly the ability to get rich on commission share is more restrained in the UK than it is in the US. But the UK is extreme. In continental Europe, it's around 3 to 4%. Property prices are only 5 to 10% lower. So I think there's plenty of scope there. And then we look at markets like Singapore, where there's plenty of commission income to be shared with the portal.
Okay. There's a question here. How do classifieds solve leakage problem on commission share for seller leads? So I think what we're talking about here is the seller lead sent, the agent goes, no, I found it from somewhere else, and doesn't then share the commission.
So it's down to process, right? Simply that you have to have a crystal clear process that this house, I have a lead for this house, do you accept it or not? So I think the clever thing is to get the agent to agree, first of all, by clicking a form on an app, yes, I accept that lead for this house on the condition that if I then manage to find a buyer for this house, then I will share my commission with you. Yeah. So I think it's very, very manageable.
Yeah, I think if you go back to a model that was tried by Rent.com many years ago, okay, and what Rent.com did was, and this was in where they would place someone in for a rental, and they wanted to get they were then going to be paid, and now what they would do is provide the renter an incentive. Tell us that you've rented via us, and we'll give you a $200 voucher for a refrigerator. So I think there's going to be these sort of trust but verify processes put in place to allow then to track what is happening. Aha, now we've got our questions working. Yes. Fantastic. Thank you. Let's take this one. How does a portal entering the brokerage model deal compete with backlash from their subscription customers?
Well, I have been answering that question for I think about 5 years now, and I think it's obviously the right question to ask. But how does a supermarket manage to sell its own brand, its own brand cereals and Kellogg's brand cereals? Or how does Amazon manage to both sell products on its own books as well as third party? I think we just have a very narrow view in the property world, and I think what matters to brokers is that they continue to get high volumes of high quality leads, and each property is different. So of course it's possible that the portal as brokerage can also get leads without that being to the detriment of the existing subscribers.
Okay, I'm not sure how should portals manage hate flows from agents? Not quite sure what that one means. Why? Let's skip that one. Why? I assume that's the same concept, right?
It is. I think it's simply an education issue, right? You know, it's simply an education issue. We'll continue to serve you as an agent with all the best leads, but some leads will simply use to sell properties on our own books.
Okay. You talked up here about the Fuzwaz .property
Yep.
deal. What for you makes that an interesting deal?
Because I think, because it is the perfect marriage between a high traffic generating portal in the form of not property, but clearly that wasn't monetizing very highly. One reason, of course, is that the average size of brokerages is quite small in the region, and therefore you cannot charge thousands of dollars a month in subscriptions. And then simply channeling that traffic towards a brokerage which clearly is able to make thousands of dollars in selling properties, that's just the perfect marriage. And it'd be very interesting to see how that progresses, but it's exactly what I think we'll see more and more of.
Okay. And we're going to talk later on today with Mike from Fuzwaz, and we're going to ask him a few questions about the initial results, because a couple of weeks in now, and I think they're starting to get some interesting outcomes from what's happening. One last question is, why would the long tail agents disappear? And wouldn't the customer change from agents to tech-enabled brokers for the pure classifieds companies?
So I think agents will disappear simply because the bigger brokerages will just do the job much better because they'll have the benefit of tech and data. We've seen travel agents disappear and banks disappear. You don't need real estate. You don't need front shop windows to sell homes, right? The internet works better. So I think I'm quite clear that they're going to disappear simply because bigger and better companies will do the job better. And I think whoever has access to the traffic of a portal will have the magic formula and be most successful.
Okay, let's do one more. As long as there's the opportunity for revenue growth and the potential for a 60% EBITDA margin and subscription revenue, why move to the tech-enabled brokerage or transaction model?
Because there may be limits to how much money you can get from the subscription level, and because if the portal is just doing subscriptions, you could well have a well-funded tech-enabled brokerage, which will take more and more of the cake. Think about the US, where who does Zillow see as their number 2 competitor after Realtor? It's Redfin. So, and that's because Redfin already has about a third of the traffic of Zillow. So you can't just hope forever that you can keep going on a pure advertising model.
Okay. Malcolm, thank you very much. Always great to hear your insights, and thank you very much.
Thank you, Simon.
Thank you.
Cheers.
Yeah. We need to give that to your